Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. After NVIDIA's blockbuster earnings report yesterday, equity markets are green, but kind of losing steam here. But a broader look at the earnings picture shows revisions have been vast so far this year, a trend almost in lockstep with the tariff story. Does this overall market adjustment on earnings revisions suggest actually a contrarian signal? And if it does, which sectors may be best positioned for potential earnings beats or even earnings meets on previous expectations? And if we have passed April's peak tariffs worries, does that also mean that recession worries maybe are in the rear view mirror? Joining us here to share her research on both the earnings picture and how she manages the math on recession risk is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise, how are you?
I'm well. How are you?
Very well, thanks. So excited to speak to you about all these moving parts all around here. So the earnings story, of course, last night was huge and everyone was waiting for that. And it was a slightly different story for that particular company, of course. But tell us about the revisions story. I mean, do you feel that this is well enough known, first of all?
We talked about before, I think it was only 2 or maybe 4 weeks ago, where, hey, if you're an investor, you got to be careful waiting for earnings as the shoe to drop before you see the all clear signal and potentially invest. And when you look at the actual data, what you've seen is the shoe has in fact dropped and dropped hard. It's been in some ways a recessionary revisionary level. So we went from, again, so typical of this whole rotation, top quartile, meaning positive earnings revisions, more numbers coming up than going down. And now we've shifted all the way down to bottom quartile, meaning more numbers coming down than coming up. And when you see that historically in the past, there's really only been one instance outside a recession. So this has been a recessionary level in terms of rock bottom earnings revisions. Now, the interesting thing is, as much as that seems pretty negative, meaning, hey, numbers, once a ball in motion tends to stay in motion. If numbers are too high, numbers are likely going to continue to come down, and they've already come down by a lot. That means corporate profits might be weak. But when you look, it's a really strong contrarian indicator. The more earnings revisions are down and the lower they are relative to history, the more likely the market is to be higher the next year. It doesn't necessarily mean that the snapback is going to be in terms of earnings growth, like, oh, they get it wrong, earnings growth is strong. It just means that usually by the point that numbers have come down so much, stocks have already priced in the bad news. And I think that might be similar to the setup that we're seeing today.
So it really was, I mean, we saw the market-wide reaction in April and analysts just got to work, didn't they, across the boards and did those and handed in those revisions. When something happens that quickly, I mean, you sort of think they must be missing, not that they're missing things, but there's a little bit of there must be some inaccuracies in there when they do something so quickly like that.
I think that's the opportunity. So you usually do find dislocations when numbers come down across the board the way that they did this time. And I think a lot of the dislocations, I mean, speaking of NVIDIA's earnings, that I'm seeing are really around technology stocks in general. And I think software stocks that we've talked about a lot before, and even semiconductor stocks in aggregate, ex NVIDIA, look pretty interesting. So when you think of all that, I mean, again, when you think numbers are coming down hard, does that mean that earnings growth has to contract? No. 53% of the time, even with bottom quartile revisions, remember that's more of a diffusion index, not a magnitude, earnings do grow over the course of the next year. And if they grow, just grow. Remember, we were before Liberation Day, expectations were around, let's call it 10 to 15%. After Liberation Day, growth estimates are around 7. If earnings estimates just stay positive, once you're in this bottom quartile revision territory, you usually get, on average, double the historic market returns. So if you don't grow, that's kind of priced in, you get average returns. If you just make it through to positive growth, that's more than enough to be a catalyst for upside risk to the stock market.
So would you say market returns, you're talking about actually the stock prices themselves, the valuations?
I'm talking about S&P 500. So
Wow.
when I say, so average returns for the
Yeah.
S&P, when you go back to the 60s, is about 8%, right? You know, you don't get those
Right.
8% returns for free. You have to put up with a whole lot of volatility, and we're living it this year. But when I say double, it's instead of 8%, you usually get 16%. So I'm looking at those patterns that are average, below average, or above average. This is an above average pattern.
This is fascinating. Let's go back to the semis just for a second because it is so much in the spotlight right now. The valuation story we know for some of the big names has come down significantly, including for Nvidia. Is there, are they sort of meeting Earth in the same area? Can you put them in a bundle, even though Nvidia is really its own story?
I think that's exactly right. I think it's very well put. I think that valuations were high enough to make it hard enough for, even if earnings deliver, for the stocks to actually work. You usually don't, historically speaking, get a lot of upside from those valuation levels. And here I'm talking about aggregate semiconductors. And it really is a very disparate universe because you have NVIDIA that grows and is also very expensive. And you have all the other semiconductors that don't really grow, but are also cheap. But even if you combine them together and looked at the aggregate earnings and the aggregate PE, the aggregate book, and the aggregate price to book, you are in those top quartile levels of valuation. And technology stocks are really no different than most other stocks, where it doesn't mean you have to underperform, but the risk reward isn't nearly as compelling. After the correction and seeing that earnings growth, specifically relative earnings growth, has stayed incredibly strong for the sector and the industry, what you're seeing is now valuations are much more normalized. And from normalized levels of valuation, and I mean that statistically in terms of, let's call it bottom half of the distribution on relative forward PE for the entire semiconductor universe going back to 1962, that provides a much more positive risk reward, usually upside to the stocks, even if you get fundamentals wrong. So I think those investors that might have maybe missed out on the technology run might have an opportunity to step in at better valuation levels here.
Fascinating. What did you take as a signal from the earnings, just as we look at it, here we are in almost June, and the second quarter and the first quarter earnings have been, we think, mostly exempt from the tariff story. And therefore, they didn't provide guidance as sort of a comment or a trend within that set of earnings. We did get guidance, quite a lot of guidance, and some real discussion actually out of this from the CEO about what the Chinese marketplace means for this company. We're like wading right into the trade story. I guess I'm just curious what you think about guidance, other companies not providing it, this company providing it, just what it all means in here, some of these signals.
Yeah, it's certainly interesting. I mean, when you look at high levels of uncertainty, it's not, statistically speaking, I mean, not just generalized uncertainty. When you look at high levels of uncertainty historically, you do tend to see guidance pulled. So that is a very common situation. I think that there are some companies that choose to wade into those uncertainties to try and either give investors context or maybe even comfort. Now, what any company decides to do isn't necessarily indicative of a trend, but I do think it's interesting that in technology, despite the fact that that's certainly one of the areas of high levels of uncertainty over what this might mean from a long run, this is one of the companies that stepped into the fray.
Right. Really, really fascinating how these earnings levels could come right back up. When you look at how we started the year, across the board, the earnings expectation story was typically high, as it often is, and that has dropped since then. Is there something in that on the earnings expectations that we should be looking for after a precipitous drop?
It is tricky. When you said that, it's funny because when you look historically, every year, a lot of the more bearish commentators will say, hey, earnings expectations are too high, or earnings numbers have to come down. That it means that the risk reward for stocks is negative. And when you look at that historically, it's true 80% of the time. Stock estimates start off too high and they come down over the course of the year. But what do we know as investors? 75% of the time, the stock market actually advances. So that's not a very good quantitative signal. And I do think it's very tricky. So I get a lot of investors that ask me, well, Denise, just pencil it out. What do you think earnings growth is going to be? And then what multiple should we put on that for a price target? The reason I don't do that is because it's really tricky. You get earnings numbers wrong, and almost more often than not, you get the multiple more wrong than you think. Meaning that if earnings growth is lower, when you look back in history for the S&P, the multiples should be higher because it's cyclical. You usually don't get trough multiples on trough earnings. So people don't adequately think about that offset. It's usually a temporary offset, which prices in stronger mid-cycle earnings. That's why I usually use the data that I do. This is the pattern I'm seeing. This is the potential for upside. And you might want to pencil it out, and it might end up coming to something, ridiculous like, 7% earnings growth, but at 25 or 27 times multiple. That doesn't seem to make any sense, but I think history is saying, be willing to accept that as a potential outcome.
That's fascinating. You did a lot of work on tariffs and trying to figure out sort of worst case scenario prior to April 2nd. And then it's a lot of it has been peeled back a little bit, and there are trade discussions, as we know, going on. Big court case decision actually made yesterday. I'd love to know your views on what it means for the tariff story ultimately, and also just sort of how that's going to fit into the economy, because we're going to ask you about recession risk in a second. But thoughts on that court ruling?
Yeah, when you go back to look at the reciprocal tariffs, that was about 30% across the board tariffs, $3.2 trillion of imports. That's, let's just call it roughly $1 trillion of tariff quote revenue. If you think that half lands on the US consumer, half lands on corporate profits, none gets absorbed through currency, none gets absorbed by the foreign producer, that would have been a 2% shock to the consumer, enough historically speaking to have tipped us into recession.
Right.
Usually recessions don't happen from shocks from tariffs, but they have in the past from oil prices. So that's sort of the framework. When you look at all being rolled back to what we think is a more likely scenario now, you're talking about 10 to 15% tariffs at that aggregate level, which is about a 1% headwind to the consumer, which has been offset now by the decline in oil prices and might actually end up getting a boost from tax cuts. So 10 to 15% is manageable. Now, what does the IEEPA court ruling mean? Well, it means that maybe some of the avenues, or we'll see what the appeal brings, but some of the avenues might be closed to this administration. But there are at least 2 or 3 other avenues to get the same end goal of 10 to 15%. It might just take longer, and it might appear a little less random in terms of the tariff threats, because there's a longer process to others, and some of which are capped. So we might end up in exactly the same place, but it actually might be, I'm a little bit open-minded to this, it might be a somewhat smoother ride, not in the beginning, but a somewhat smoother ride in terms of the visibility for markets.
That's interesting, because of course we saw the very visual chart that had some extraordinary tariffs put, well over 100% on certain countries. And that was within the framework that now has been ruled you can't do that, but you can still put tariffs on in other ways. Can they put them on with those massive amounts in the same ways through these other? I'm asking you to be a lawyer here, but you don't have to answer that question. But I'm just curious: can they get to those crazy elevated levels from which they then come down?
I'm not a legal expert for sure, and I think it might be possible, but not probable. And I think it would be longer and harder to do from all of the experts that I've talked to.
Okay, really, really interesting. So when we take a look at, again, going back to April, discussions for recession, is it going to be filtered across the economy and we all sit with it through sort of Q2 was one of the stories. We've come back in the stock markets. Stock markets tend to look through things. Will we be left with a recession in the same way? Can we look at it in the rearview mirror, that risk itself, and we're moving on? What does your math tell us at this point?
Might be. I mean, that might be the case. I mean, especially in some ways that will integrate the court ruling that we just talked about. If that makes it a little bit harder to create 30%, 50%, 100% tariffs, and the tariffs are more likely to end up in that bucket of, again, let's call it an estimate, 10 to 15%, where you're adding in some sectoral tariffs, you've got sort of the reciprocal tariffs, maybe even some trade barriers do in fact go down for the negotiations, which provides its own offset. That's not enough of a shock, historically speaking, to tip the consumer into recession. So again, going back to the tariff math, I mean, it is a tax. It's an indirect tax, so we got to make some guesses on where it all lands. But the guesses on where it all lands, again, back to that 10 to 15%, half lands on the US consumer. That's about a $250 billion headwind. But if you look at the tailwinds, we have about a $250 billion tailwind from lower oil prices. So this is not insignificant. And one of the reasons, when you look back in history, there have been 3 instances of tax hikes historically that approximate about 1% of income: 1968, 1993, and 1982, I think were the 3. And none of them were recessionary. And the reason is not because that's not a giant headwind. It absolutely is. But I think what it shows you is be careful betting on that being enough of a headwind, because there's all these offsets lurking in the background. So offset number 1 is energy prices. Offset number 2 could be the tax bill that we're talking about, right? So 150 to potentially 300 billion for the consumer that'll be, retroactive, but more in sort of the second half of this year and the first half of next year. So you end up in a situation where the market might have priced in a situation of a $250 billion or a $500 billion at the time headwind to the consumer, where really now when you look out over the next year, it might be in a situation there's a little net stimulus and no headwind. In which case we can say, well, what did we learn from 2022? In 2022, the very hard soft landing, or the very soft hard landing, was a peak to trough contraction in the S&P of 30%. So it was more than our 20%. But we had fully priced in a recession that didn't end up happening. So what happened over the course of the next 2 years? So I get a lot of questions on, Denise, is this 10% or 15% snapback in the S&P fully pricing a recovery? Again, going back to 2022, what did we learn? Off that low in 2022, stocks were up 65% over the next 2.5 years. So be careful thinking that little, and I mean it in context, little moves in the short term lead to a fully pricing of recovery scenarios in the equity market.
We saw some eco data coming out this morning. There's initial jobless claims. It mentioned this mostly because it looks like yields are coming down on treasuries. There's a bid into treasuries. Some commentators will say, well, there's a wobble, and so maybe the Fed will have to cut sooner than we thought, and then the yields come down. And so on that, there's other reasons why this is an interesting story. Maybe they're less than competitive for the equity market, and that's good for equities. Would you weigh in just on what you're seeing and some of the data rolling in here?
Yeah, it's interesting. I got some questions from portfolio managers this morning on the weak consumption numbers. And I do think that some of it is just a struggle with a seasonal trend, because when you look at the year-on-year real consumption growth indicators, or even a 6-month trend or a 3-month trend, you see it a more steady trend. Consumption growth is, I'm going to call it loosely, fine on that average level. So you're not really seeing an air pocket in terms of the consumer saying, no more, I don't want to spend. So I think that stagflation that we're seeing in terms of the data this morning is a little bit overplayed. The interesting part, how it relates to the equity market, is I think you're right. I think the bond market is, today at least, pricing in more odds of rate cuts and maybe even higher odds of a recession because consumption growth slowed. The interesting part about those is that you would think that would benefit equities. Right. But what you've seen in the past is lower rates have actually been not as good for equity markets, at least from a coincidental perspective, as you might think. And it goes back to the fact that the why behind lower rates matters more than what rates are, which is to say that if rates are higher, and we can talk about higher 30-year treasuries or higher 10-year treasuries over the course of the last, let's call it 3 months, that if it's a function of higher growth, the equity markets have very little problem with it.
Right. Okay. There's a question on growth. So let's put that straight to you. It's on the tax cuts. So how, Denise, will tax cuts under the current administration impact growth? And I guess they got to get through first. But yeah, the question stands.
So I will say, statistically, it's interesting when you look at taxes and what it has meant to income, spending growth, or profits, or the stock market overall. I have to say, personal tax cuts do very little to move those things, which is not to say that they're not significant for any individual who either gets a tax cut or a tax hike, but it's mostly that they don't provide a real offset to, or a real significant driver behind income growth or even unemployment. Those are the 2 big drivers behind income and the consumer and consumption. It is different for businesses. So when I say, I think it might be 150 to, let's call it 300 billion, depending on the way it all pencils out for the US consumer, the more important tax cuts I'm seeing are really on the corporate side. And that's also, let's call it 300 billion to 500 billion in bonus depreciation, R&D expensing that had all rolled out and off under the previous administration. So to have those additional tax stimulus back in, again, if you're worried about the consumer being hit enough to tip us into recession, you always want to be mindful of corporate profits and that reduction that we've seen in terms of taking earnings estimates down on tariffs. They might have to be taken back up based on corporate tax cuts.
Wow.
And that might be important for investors to consider as well. So when you think about that shared math, right, back to that, let's call it 500 billion shared equally between the US consumer, 250 to them, 250 to corporate profits, $4 trillion of corporate profits in the United States. That's about a 7.5% headwind. And if you say that this is, again, a $300 to $500 billion tailwind for corporate profits, you might have offset the tariffs.
Wow. Which is sort of what they said they do with the three-legged stool or the three arrows in the quiver or whatever terminology you want to use. This was, and deregulation is the other piece, but it does look like we're getting there on the tax cut discussion. Right. Another question, just wondering on the lower USD, the impact on trade, growth in Canada, but maybe just for the more global story of when you have a lower US dollar, what does that growth story look like probably for the US on a relative basis, and a new relative basis?
The irony for a lower US dollar, when you backtest it historically, it's better GDP and better corporate profit growth. I mean, in part because what you see is corporate profits in the US, 40% of the revenues comes overseas, right? But those are US listed firms in the S&P 500. So it's partly that, which is just currency translation, but the market pays for currency translation. But it's very hard to say that a weaker dollar ever relates to weaker US growth on either a coincident or on a go-forward basis. So currency in some ways is idiosyncratic. I think we want it to mean something that statistically it has not meant historically, whether or not it's a reserve currency, whether or not the US is growing rapidly, whether or not the US is beating the world. I mean, there's just some relative rate differentials, relative growth differentials, your starting point on valuation and relative sovereignty and debt that impacts the currency market that's not potentially indicative of future growth of the US. So I'm not quite there with the decline of the US dollar and meaning as being symbolic of the decline of American growth options.
Take us back to looking at recessions, how often they do in fact hit. I think one of the big pieces of the recent recessions that we often go back to were such enormous upheavals, the great financial crisis, followed by other types of real problems around the world, that sort of translation, contagion feel. That doesn't happen very often, but do we talk about, what do you think would come out of what we're in right now? If it would look more like a garden variety recession, which I think you pointed to before, or if the risk is something much bigger than that?
Yeah, it's funny. You can never say garden variety recessions when you're in them. So I do think that the funny thing about the stock market is, I think a Peter Lynch quote was, the stock market predicted, 16 of the last 5 recessions. So you always do have to keep that in the back of your mind. And I just did a USA Today piece about just how tricky recessions are, because even if you're in one, you don't know you're in one until 6 months after you've been in one. And since stocks bottom halfway through recessions, by the time you figure out you're in one, stocks have usually bottomed. So it's very tricky as an investor to even think through what recessions might mean. And I always give that quote of what was the low in the stock market between 1976 and 1985. The recessions were in 80 and 82. The low in the stock market was in 1978 before either of the recessions. So sometimes, even if recessions are very visible, and they were when Volcker came in and said, I'm going to raise rates high enough that we will have a recession. When recessions are visible, you can discount a whole lot of bad news in advance. It doesn't mean that the ride won't be bumpy. But if you had a 5-year view, even during that time, we had 2 back-to-back recessions with 20% interest rates, you still would have made money in equities. So I think that there's a lot of really tricky parts about recessions as you think through them as an investor. Like, does it always mean you want to sell, even if you know one's coming up? Well, it still depends on your time horizon. So I do think that we might look at the last, let's call it a couple of years and maybe a couple of years in the future as almost growth recessions. That you didn't quite have the contractions that you've had in the past, even in 2000, in like 1970, that were the more garden variety recessions that were, maybe only contractions in the stock market of 20 to 25 to 30%, as opposed to the secular bear markets of the financial crisis. These look more like growth slowdowns where the market quickly prices in a recession that might not happen, which, as volatile and as scary as it is sometimes for an investor, does usually give you the opportunity to position against that for upside.
So let's go right into positioning for that, particularly across sectors. We started off talking about tech, one of the biggest tech name. I think that's your top sector. It has been for at least a couple of weeks, couple of months. Take us through top three, bottom three.
Yeah, not that long. But technology is without a doubt tops. And I think going into the correction, if you asked me, it was financials. And I think that that's one of the, I shouldn't say fun, but for me, interesting parts about corrections is you usually get a dislocation and you usually get an opportunity. And so the opportunity was no longer financials, although I think that the risk reward is still positive. But I think that the real opportunity is in technology. Technology looks to me on the data, and I know you shouldn't compare them, but much like financials looked 18 months ago, where you're in that valuation zone where I don't really have to get earnings growth right. I don't really have to get operating margins right because your risk reward, at least historically speaking, is pretty good because the stocks have a rich history of pricing in bad news in advance. It's exactly where we are in technology right now. So technology is number one. And two and three, but I'll give you two others, which is to say consumer discretionary and still financials, mostly in brokers and capital markets as opposed to banks on that side. And the bottom three would be not changing a whole lot either. It would be those defensive sectors like consumer staples, healthcare, utilities, and I'll always add in energy until we get to more normalized levels of profitability, which might create an opportunity in some scenarios, but we're not there yet.
Interesting healthcare, because at one point it was evergreen. It could kind of go both ways. But it's got some different structural pieces to the story now.
Now it has a lot of structural pieces. I think evergreen was very, very true in the 80s and 90s, where what you saw was it was both offense and defense. Why was it both offense and defense? Because operating margins went up on a secular basis. That looks more like what sector? Technology now. Right. Technology looks more evergreen to me in the data. Now, healthcare, when you look at the operating margins, again, we have the data going back to 1962. Operating margins peaked in the late 90s, early aughts, and have been declining ever since. And that's why I think you have to be really careful talking about valuation because it sort of starts to screen like a value trap, meaning that you think it's low in the relative multiples, but if they're really less profitable than they have been in the past, how much do you want to pay as an investor?
That's fascinating. So what would you leave as kind of a final thought for investors? All of these wild things are still going on. It's been quite a ride thus far this year. What would be sort of a final thought that you'd leave with investors?
Yeah, I think what we've seen over the course of the last couple of months highlights the quote that I always like to say, which is the only people who get hurt on the roller coasters are the jumpers.
That's so good. Oh, let's leave it on that. Fantastic. Denise Chisholm, thank you for joining us today on Fidelity Connects. It's great to see you as always. Have a good day.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.